UK government borrowing costs have risen to their joint highest level since the 2008 financial crisis. The 10-year gilt yield crossed back above 5% on Tuesday, and the proximate cause is crude oil trading above $111 a barrel for the first time in 3 weeks. That connection is not accidental. Britain is almost uniquely exposed among developed economies to the ongoing energy shock. Oil and gas imports feed directly into the Consumer Price Index, and with CPI already at 3.3%, well above the Bank of England's 2% target, every uptick in Brent adds pressure to an inflation picture the bank has struggled to contain for 3 years running. The UK's spread over US Treasuries has reached 70 basis points for only the second time since late 2025. That number tells a specific story. It means investors are demanding extra compensation to hold British debt, not because of a fiscal emergency today, but because of accumulated credibility damage. The Bank of England has consistently run higher inflation than peer central banks since the Russia-Ukraine energy shock, combined with the Liz Truss mini-budget in 2022 to push prices into double digits. The 2-year gilt yield, which tracks the expected rate path most closely, has risen by a full percentage point since the start of March. That move alone has unwound most of the rate cut bets traders had placed at the start of the year. Citi AM's Shadow Monetary Policy Committee voted 8-1 to hold at 3.75% this week. But one former MPC member, Jonathan Haskell of Imperial College, called for a hike, arguing an early move would do more to anchor inflation expectations than waiting. Ruth Gregory at Capital Economics called the upcoming decision the stuff of nightmares. The data coming in, stronger than expected Q1 growth, rising pay expectations, sticky inflation, point in conflicting directions. The bank faces a trap. Signal too much hawkishness and it risks another shock to mortgage markets. Signal too little and it risks embedding inflationary expectations that become self-fulfilling. 50 days into the Iran war, Wood Mackenzie estimates that an equivalent of all global road travel for 11 days has been removed from supply. Physical shortages are already appearing at the margin. Media reports of tanker arrivals in Japan and diesel shipments to Australia are masking how thin the buffer has become. If ceasefire talks remain deadlocked, as they did again on Tuesday with Brent jumping on the news, gilt yields will continue to price in a higher for longer rate path. If a breakthrough comes and oil reverses, the 2-year yield could fall rapidly, repricing cuts back into the curve. The verification point: watch whether the 10-year yield holds above 5% through Thursday's Bank of England decision. A close above that level after the announcement would signal markets have lost confidence in near-term cuts entirely. That same inflationary pressure drove one of the most chaotic 24-hour policy sequences in recent British political history. Late Monday, The Guardian reported that Chancellor Rachel Reeves was considering a 1-year freeze on private rents in England, an intervention aimed at shielding tenants from the Iran war cost of living pressures. The reaction was immediate. Shares in Paragon Banking Group, one of the country's biggest buy-to-let mortgage lenders, fell 2.4%. OSB Group, which owns Kent Reliance and Precise Mortgages, dropped 3.6%. The FTSE 250 firms were pricing in a world where landlords' income is capped by statute, and their incentive to remain in the sector evaporates. The British Property Federation called it inept, knee-jerk government intervention. The National Residential Landlords Association warned it was reckless to create that level of uncertainty in the same week as major rental reform legislation came into force. Robert Colville of the Center for Policy Studies cited the Swedish economist Assar Lindbeck's verdict that rent controls are the most efficient technique for destroying a city apart from bombing. That context makes what happened in the Commons on Tuesday even stranger. Asked directly whether she would implement a freeze, Reeves told MPs, "I will do everything in my power and use every lever we have to bear down on the cost of living, including for people in the private rented sector." She refused to deny the policy was under consideration. Hours later, a Downing Street spokesperson issued a flat denial. "We have no plans to implement this." Then a second, harder statement followed. "Just to be completely clear, that is not the approach we will be taking." The episode reveals a structural tension inside the Labour government that is unlikely to resolve quietly. Housing Minister Matthew Pennycook had explicitly opposed rent controls only 2 weeks earlier, citing evidence from Sweden, Germany, and San Francisco. The fact that the Chancellor was nonetheless reported to be considering the policy and did not immediately deny it in Parliament suggests the inflationary pressure from the Iran war is generating internal political demands for visible action, regardless of the policy's economic logic. A Lords committee separately warned on Tuesday that Reeves' fiscal rules buffer should be significantly larger, saying the UK's public debt trajectory is unsustainable. Some of that headroom has already been eroded by the war's impact on borrowing costs.
The political pressure to act on cost of living without breaching fiscal rules is intensifying, and rent policy is not the last place that tension will surface.
Away from the domestic political noise, Tuesday produced a structural shift in global energy markets. The United Arab Emirates announced it was leaving OPEC after 60 years of membership, the third largest producer in the cartel, walking out at the moment of the organization's greatest test. The UAE's departure weakens Saudi Arabia's ability to use collective production discipline to manage prices. It is a direct win for Donald Trump, who has publicly accused OPEC of inflating oil prices and pressured members to increase output. But the timing, in the middle of a supply crisis caused by Strait of Hormuz disruptions, means its practical effect on global oil supply is constrained. The UAE cannot unilaterally replace the volumes lost to the blockade. The more immediate beneficiary of Tuesday's energy disruption is BP. The oil major reported a sharp rise in profits in its first results since the Iran war began, with oil above $110 providing a revenue windfall. BP shares led the FTSE 100 fire, partially offsetting losses elsewhere in the index, driven by housing and financial stocks. That contrast, BP rising while house builders fall, captures the market's current anatomy. Taylor Wimpey, which builds more than 10,000 homes a year, reported a 6% year-over-year fall in its forward order book and warned of cost surcharges coming through from its supply chain. Travis Perkins, the builder's merchant chain, reported revenue down 1.7% on a like-for-like basis in Q1 and called conditions challenging. The financial sector produced its own divergence. JP Morgan announced it was relocating trading roles from Paris back to London, a reversal of the post-Brexit migration, citing an overestimate of the EU staff it would need and personal tax considerations. JP Morgan's Canary Wharf Tower project, announced after last year's autumn budget, remains contingent on the government maintaining a favorable tax environment. Barclays, meanwhile, reported a £228 million hit from the collapse of mortgage lender Market Financial Solutions amid fraud allegations, and said it was pulling back from lending to riskier borrowers. The weight of evidence points toward continued gilt yield pressure through at least the Bank of England decision on Thursday, but that leaning depends on oil staying above $110 and ceasefire talks remaining stalled. If the Strait of Hormuz situation shifts materially in the next 48 hours, the 2-year gilt yield could move by more than 20 basis points in a single session. The benchmark to watch is whether Brent crude holds above $108 into Wednesday's U.S. session. If it fails that level, the rate hike narrative loses its primary driver, and the housing and financial stocks that have sold off this week would be first to recover.